All right, welcome everyone to today's webinar, US equities, the wait is over. A nod to both the high levels of concentration we're currently seeing in the US market, but also a nod to the timing. And this webinar comes at a very interesting time for global markets, but in particular in the US. If we look back to 2 months ago, we saw the US CPI print come out, and since then, somewhat of a reversal of recent market performance. The Nasdaq 100 actually down 5% or so, and the S&P 500 equal weight up 5%. So this rotation, a lot of discussion around rotation. So it's a very timely time for a webinar around the US market, and in particular, different indexing methodologies within the US. Before we get into that though, just very quickly, a disclaimer here, just to let you know that everything today is general in nature. We don't take into account any of your own personal circumstances when making comments. And just one more formality, just on the webinar system, please do ask questions. Me and our guest Tim will endeavour to answer some of your questions at the end of today's webinar. And also importantly, a recording will be sent to you following the webinar as well. So with that, I will introduce myself firstly. My name is Tom Wickenden. I'm an investment strategist here at BetaShares, responsible for running webinars as well as writing insights and doing research on our entire product suite. But I'm very excited to be joined here today by Tim Edwards. Tim is the global head of index strategy with S&P. Tim, he runs a team that you might be familiar with some of their amazing research. We often, quite heavily quote the SPIVA reports, for instance, the S&P active versus passive, and Tim and his team or Tim himself, sorry, is in charge of the team who generates those reports. So Tim, welcome to the webinar today.
Hi Tom, thanks for having me.
Yeah, no worries. It's always a pleasure, and I'm also personally looking forward to Tim's one of the great presenters, and always good for a chat around indexing. So with that, just the S&P's disclaimer as well, and then we'll jump into the webinar today. So Tim and his team, they released a paper not long ago. It was about a month ago now. A fantastic research report, titled "Worth the Wait." And this talked about the S&P 500 equal weight index, and it touched on not just the short-term performance or the short-term market circumstances around the US market, but also the long-term benefits of an equal weight index. And we're going to dive into all that today. But Tim, maybe as a starting point, if you could give us a brief introduction of what the equal weight index is, and also help the audience out with why we're making reference to so many weight puns.
Absolutely, my pleasure. And now's when I test whether or not I can move slides forward. And behold, I can. Wonderful. So please be introduced, if you haven't met it before, to the S&P 500 equal weight index. It is related to the S&P 500. The S&P 500 itself was created in 1957, and it is what's called a capitalization weighted index. Essentially, it is weighted in the same proportion as the overall market. The overall market has more money in stocks with larger capitalization and less money in stocks with lower capitalization, and the S&P 500, like many other indices, just reflects that market capitalization weighting. The S&P 500, the classic one, essentially represents how all the money in the market is doing. The S&P 500 equal weight is a simple, I think, relatively simple, but different index. It is the same 500 companies, but rather than weighting so that there's more money in the larger stocks, it weights all of them equally. It's a newer index. It was launched, the equal weight index was launched in January of 2003. And there is a back test, a sort of hypothetical, what would this index have looked like had it existed at the time? And I think all these sort of back tests should be viewed with suspicion, but the equal weight index back test is one that I personally am a little bit less suspicious of. The S&P 500 existed at the time. Hypothetically, what would it look like if you just did an equal weighting of 1/500th in each stock? I think that's something that is meaningful and perhaps not over engineered. So how does it work? You already know half of it. It's the same 500 companies, but a weight of 1/500th in each, as opposed to their market cap weight. But that's not quite it. if you build a portfolio like that and you hold it, after a certain amount of time, some of the things you own will have done very well, some will have done not so well, and you will no longer be equally weighted. So there is a rebalance which acts to bring those weights back in line. You'll sell a proportion of things that have done relatively well, buy things that have done relatively poorly, bring that back to equal weights, and the S&P 500 weight rebalances quarterly with a rebalancing that basically follows that of the main S&P 500. Tend to be periods when there's more liquidity in the market overall. So that's it. Reassuringly simple. In terms of, I mentioned at the beginning, the S&P 500 represents the overall market in the sense of, all the dollars invested in the market. The S&P 500 you can think of as representing the performance of the average dollar. Intriguingly, the S&P 500 equal weight represents the performance, certainly in between rebalances, of the average stock. If you wanted to know how did the average stock do, you'd add up all the stock performances and divide by the number that you started with. That is exactly how you calculate the return of an equal weight index. So think of the S&P 500 as representing the average dollar, the S&P 500 equal weight as representing the average S&P 500 company performance.
Yeah, it's great. Thanks. I mean, as you said, so simple, but as we're about to get into, so much underneath it, right?
Yeah, there really is. Look, we have a lot of indices, and we love all our children equally. But among all the children that we love equally, equal weight is one of my favorites. Shall I move on? Okay. Why is it interesting now? In terms of the way this presentation is going to run, I want to share a few observations on why the equal weight index, like right now, is particularly interesting to look at as an index, as a benchmark, and then we'll move on to kind of longer term characteristics and patterns. The first and possibly the most important one is the level of market concentration. And what do I mean by this? So the US equity market overall is more concentrated today than it has been for quite some time. And by concentration, I mean the weights in the sizes of the largest stocks compared to the rest are much more significant than usual. There's lots of different ways you can measure concentration, but I'll give you one that to me is quite intuitive and also sort of accounts for the factor that over time the overall market inflates. So at the end of the first half of 2024, if you took all the companies in the S&P 500, you measured their market capitalization, and you took a simple average, the average S&P 500 company has a market cap of around $100 billion, 96.3. But the capitalization weighted S&P 500 puts, as we've explained, and as you probably know, puts more money in or more allocation in the larger companies. And if you do a weighted average, the index weighted market size is nearly 10 times as much, or in fact, slightly over 10 times as much, nearly $1 trillion, $998.6 billion. And that ratio, right, how much bigger are the companies on average in the market cap index versus the equal weight index, is quite a clean measure of concentration that you can run back historically. And that's what this chart shows you. It shows you now roughly 10 times larger companies on the cap weight versus equal weight. We have been there before. Similar levels of concentration were observed in the late 60s, early 1970s. But over the last 50 years, this is an unusual level of market concentration.
Yeah,
so that's, yeah, sorry, go on, Tom.
No, I was going to say, I was just going to jump in. One thing I find quite interesting, that second statistic there, so the index weighted average market capitalization is almost $1 trillion. And the reason this piqued my interest is people might have seen last month in the news that Berkshire Hathaway became the 9th public company ever to reach a $1 trillion market capitalization. There's only 9 companies that have reached that mark historically. Of course, the other ones are the large mega cap technology companies that are in the S&P 500. But for the entire indices, index weighted average market cap to be at that $1 trillion mark, where only 9 companies have reached before, it just shows this incredible influence those companies are having on the index, and comes to your point as well of how significant those larger stocks are at the moment compared to the average stock.
Yeah, look, there's two reasons why concentration, as measured in a way like this, is important to think about in terms of the relative value or interest in equal capitalization weighting. The first is super obvious. The second is obvious when you think about it. So the really obvious one is in terms of thinking about portfolio risk. The S&P 500 is a diversified basket of 500 stocks, and I don't want to overplay this. But what you have seen in sort of the market dynamics recently is because there are a few companies that have come to represent a very large component of the benchmark, because those companies are in similar sectors, largely in technology or communication services, and because those companies themselves have got quite a volatile and sort of idiosyncratic degree of performance, and I'm thinking of companies like Nvidia. Thinking about portfolio risk within a US equity allocation during periods of higher concentration is more connected to potentially individual company names. So risk that you could diversify but isn't diversified. And so that's one reason why concentration becomes important as a measure, just thinking about the balance of risks. The other, which is slightly less obvious, but very intuitive when you think about it the right way, is how does, ask yourself, how does concentration increase or decrease? Well, the most obvious way for concentration to increase is the very largest companies get bigger on relative terms. Concentration decreases when smaller companies increase in their size and start to catch up. And that is very obviously connected to the relative performance of equal weight and capitalization weighted indices. Cap weight, more money in the larger companies, or more allocation to the larger companies, which will do better if those bigger companies do better. And the next slide, if I can find the button, forgive me, there it is. We went forward. Oh, I think we both helped each other there. Okay, there we go. Pardon us. The next slide shows you this relationship between equal weight, relative performance, and concentration. So the yellow line is the cumulative relative total return of the equal weight index versus the capitalization weighted index. Yellow line going up means equal weight outperforms. Yellow line going down means equal weight was underperforming. And visually, you can really clearly see the correspondence between the two series. The only thing I'd add is just to emphasize, concentration isn't the only factor up and down in equal weight relative performance. And this is visually illustrated by the fact that if you look over that full period, 1970 to today, concentration is exactly back where it was. But over that 50-year period, and again, including some back test, right, the equal weight index was launched in 2003, but over that full period, you can see that although concentration was returning to periods where it had been before, over that period, the equal weight index had actually outperformed, and that is a hint that there's slightly more going on. Okay, we will come back to the sort of longer term performance, but just adding to that sense of, why do I think equal weight is interesting now? And that the next thing I'd like to point out is that concentration trend, that outperformance of whether you want to think about the Magnificent Seven or other groupings of stocks, they have been performing extremely well relative to the rest of the market. That's why the concentration has increased. And they are part of an overall momentum trend, which seems to be, if not stretched or overextended, then at least quite dramatic compared to history. So we have an easy way of measuring this, that there is something called the S&P 500 Momentum Index. This is an index that picks the 100 stocks of the S&P 500 with the strongest one-year price momentum. That has a nearly 10 years of life history, also has a back test to the 1970s. But what I wanted to illustrate here was, if you, and this is a broader truth, right? If you look at trend following strategies, momentum strategies, overall, they tend to have a positive performance. Not all of them do, but momentum works or has worked historically. That's why this 12-month return series, trailing return series you see tends to be above zero. But momentum also has these periods of really strong performance that tend to be followed by sharp reversals. So the trend is your friend until it isn't, is essentially a message that you might take from this chart. But the second thing I want to highlight, and so the right-hand side peak, that peak occurred at the halfway point of 2024. We were looking by the midpoint 2024 at an extension of momentum in the US equity market that wasn't unprecedented. We'd been there during the excesses of the technology bubble in 1999-98. But it was a sign that the trends were very stretched, and that's interesting to kind of think about in the context of, you know, when and will the winds change. Mm-hmm. Another reason I think, you know, sort of amplifies the interest or the importance now is it's making more of a difference than it normally does. So here, this is looking at the trailing correlation between the bond markets, essentially US 10-year US Treasury yields, and two different equity indices, S&P 500 equal weight and S&P 500. And if you observe, so this is back to 2001, it's live history for the equal weight index. Most of its history, there was no difference between the equal weight and capitalization weighted relationship with treasuries. The two lines are near identical. But through the COVID pandemic in 2000, and again more recently, the correlations have become more distinct. That tells you that there's something different going on in terms of the interest rate sensitivity of the very largest companies and the rest of the companies. And that makes the sort of decision to equal weight or not kind of more important in terms of a portfolio construction. And the last thing, I guess, to mention in this section is there are signs, early signs. I don't want to overplay this, but there are signs of a change in the winds that may have begun around that sort of summer period. And just giving you some evidence of this, this is looking at the first half of 2024, and then since then up until the end of August. And first half of 2024 was the same trend that we've been seeing for quite some time overall. Outperformance from the very largest stocks, as represented by the top 50. I should say this is all relative performance versus the S&P 500. Underperformance by equal weight, underperformance by mid caps, underperformance by small caps, and we have, excuse me, we have seen or started to see signs of a change in the winds. When you add it all up together, that was, I guess, one of the motivating factors for us publishing this worth the wait paper, and I guess kind of trying to draw the market's attention to what we thought was an interesting dynamic and a particularly or interesting time to compare equal capitalization weighted indices.
Yeah, no, 100%. And I might even, we had a question come through, so I might even jump back very quickly before we move to the next section. We've shown a chart similar to this, thanks to S&P and their data, to our clients a few times. And the way we've shown it historically is the concentration in the top 5 names as the blue line. The reason I bring it up is someone's asked, you know, if we do continue to see a bit of an unwind in those magnificent 7 names, in those large cap technology names that myself and Tim are alluding to, if they continue to underperform the rest of the market, what type of relative performance could you expect from the S&P equal weight versus the S&P market cap weight? And okay indication, and you can see in the blue line there from around 2020 to 2022, there's actually quite a sharp decline there in the, you know, in this chart we're looking at the, you know, concentration difference between the average and the index weighted market cap. And in that sharp decline, just to give some historical numbers, we saw about a 5% decrease in the concentration of the top 5 names in the S&P 500. And over that period, we saw the equal weight outperform the market cap weight by about 16%. Now, of course, there are other factors at play, which we're actually going to go into very shortly, but just to give investors an idea of how much that difference in performance can be when we do see concentration subsiding. And you can see now at the very end of the line, the very small drop down of the blue line, and that small uptick of the yellow line is what me and Tim are referring to when we talk about this potential changing of the winds. This is very interesting time for markets. And that, I guess, quite nicely segues into the second part. We've talked a lot about, you know, the contextual environment, the large levels of concentration, potentially momentum mean reverting. But as Tim also alluded to, over the very long term, the S&P 500 equal weight has actually outperformed the market cap, which is particularly impressive considering this, you know, past 10-year period really of quite strong performance from large cap names. So it'd be really good, Tim, to, I guess, look under the hood a little bit at the other factors that tend to drive the equal weights performance and outperformance over time.
Yeah, let's get into it. Look, so first off, this is now we're going to talk about the live performance of the index. So over its lifetime, on the first column here, 12%-ish, 11.5% total return. As you point out, Tim, despite this being an overall period in which concentration increased, it has, while alive, just about still outperformed the S&P 500. But more interestingly, in terms of thinking about other things that people might compare this to, materially outperformed on an annualized basis, small caps and mid caps. Over shorter periods, I guess, since the end of H2, outperforming, but over 5 years, 10 years, 15 years, it has underperformed, and for reasons that are primarily to do with the themes that we've already discussed. But notice that over all the time periods reported, 5, 10, 15, 20, it has been doing better than the small cap space and the mid cap space. So how's it done that? So one thing, just to sort of acknowledge before we move on. So in understanding the short-term performance of the equal weight index, it's often quite useful to look at sector perspectives. And this, historically, for example, during the technology bubble, the cap-weighted S&P 500 had a very large allocation to technology. Just in advance of the 2008 US banking crisis, the S&P 500 had a very large weight in the financial sector. And that, compared to equal weight also, right? Because as the capitalization gets very large, gets a larger weight. Equal weight, the sector weighting is essentially determined just by the number of stocks, right? If there's 10 stocks in the financial sector in the S&P 500, then they'll get a 10 divided by 500 weight in the equal weight index. And so in the short term, sectoral differences, it can explain a lot of what's going on. However, interestingly, in the long term, sector differences don't matter a lot. And this is a long-term attribution. That the blue bars are essentially showing you how much difference for the overall equal weight index came from under or overweighting that sector. The yellow bars are showing you how much difference did it make by equally weighting within each sector. And over the sort of, and this is done on a quarterly basis, but over all the quarters that S&P 500 equal weight was alive, actually, the sectoral allocations were a slight cost. All of the excess return came from equally weighting within each sector. And if you sort of look across the sectors, the fact that the yellow is on the right-hand side of this within all the individual sectors is telling you that, not all, sorry, there are a few where it's on the left-hand side, but in the majority of sectors, it really helps by equally weighting within each sector, which I'm not going to go more into. We do have other research on it, but I think it's intriguing to think about this in terms of within each industry or within each sector. Often, a leader arises within each industry or sector, and then they get challenged, and there tends to be a sort of ebb and flow of concentration over time. But overall, the sort of equal weight and rebalancing has proved to be a positive way to approach both on an overall market and within each sector.
Yeah, just quickly, I mean, it's almost intuitive that those top three sectors with the yellow bars on the left-hand side, those are those industries where you've had those leaders around for such a long period. You haven't had that ebb and flow of competition we've historically seen. Hence why those would be the ones that stand out for the not contributing on an intra-sector weighting basis.
Yeah, this is actually one of the two exhibits where what I'm showing is quite strongly influenced by the particular circumstances of the period that we're studying, right? IT, consumer discretionary communication services. I don't need to tell you the names that might have been an important factor in driving that. But from sectors to factors, most obviously and somewhat reassuringly, there is a size component in terms of smaller size component to equal weights performance. And look, let me point out something super obvious, right? It's an equal weight index. The bottom 400 out of 500 stocks are going to get about an 80% weight. In the S&P 500, as of the end of June, there's only 20% weight in total on the sort of the right-hand side 400, 56% weight, more than half in the S&P 500 in the top 50. Now, because concentration is relatively high compared to history right now today, this is more of a differential than it would have been normally, but throughout its history, equal weight, as you might expect, has had a smaller size exposure. And that's one of the most important things in understanding, how it's performed from a factor perspective. In terms of the overall long-term returns, it can explain a lot. And this, if you want the details, it's in the paper. But the idea here was, well, how about if we built an index that was composed in part, a hypothetical index composed in part of the S&P 500, and then plus an allocation to mid caps, so that the overall average size matched that of the equal weight index. And we call this a size match portfolio. Back tested it on average over the full period. We got a sort of 80% in mid caps, 20% in large caps, and you can see here that the result is the blue line, and you can see that it looks quite similar to the yellow line. Point of which is to say, size can explain a lot. However, the scale on this chart does disguise an important fact. I mean, this is a real zoom out. You can see that the blue line is not exactly following the yellow line. If you zoom in, there is an annual differential in returns as big as 20%. And so this is what that looks like. So in dark blue solid line, here's the return, 12-month trailing return of equal weight versus a portfolio that matches its size exposure, but is comprised of S&P 500 plus S&P 500 mid-cap 400. And that's showing you that, yeah, look, it was up to 10% above, 20% below, or more in terms of relative performance. The dotted line is showing you the relative performance of that momentum index I introduced earlier. And that illustrates something quite important. So we go back a couple, how is the equal weight index defined? Well, 1, we equally weight. 2, we have to rebalance. When you are rebalancing an equal weight portfolio, what you have to do is the things that have done relatively very well, you have to sell to get back to equal weight. The things that have done relatively poorly, you have to buy to get back to equal weight. This gives it a sell your winners, buy your losers, an anti-momentum characteristic, which the sort of size matching portfolio doesn't have. And so it's intuitive, and you see it in the data. The sort of the biggest residual factor after size is actually an anti-momentum component that comes from the rebalancing. I find this deeply satisfying, right? It weights equally, you get a size exposure. It rebalances, you get an anti-momentum exposure. If you sort of run regressions and other such analysis, you can sort of find out size explains about half of all the variations in excess returns. Momentum explains about half of what's left. If you wanted to, you could add more factors. You'd find a bit of exposure on equal weight to slightly more of a value play, as you should expect, slightly smaller companies, slightly more of a dividend play. It tends to have higher dividends paying stocks. It's a bit more of the value size. And if you add all that up, sector, factor exposures, you can understand that a lot of what the relative returns are. But there is one more perspective that I'd like to introduce, and that, in order to explain that, I need to explain what I'm going to show you here. So this is sort of completely different. We're going to take an individual stock perspective. So what I'm showing you right here was built in the following way. Over the 20 plus years since the equal weight index was launched, there was about 1,000 stocks that were members of the S&P 500 at any point during that period. And take all those 1,000 stocks and ask what was their return while they were in the index. Okay, so, and this is showing you what happened to all those stocks. So left-hand side of the chart, roughly 10% of stocks, 1 in 10 stocks went down from 50 to 100%. And so on. And what I want to emphasize here is the skew of the distribution, the sort of fat right tail. Nearly 10% of stocks doing 10x or more. This is not unusual, by the way. If you took the prior 20 years, the numbers would be different, but you get a similar chart. If you look at the Japanese market, European market, it's a fundamental feature of stock markets. They can go down up to 100%, but their gains are unbounded. And very often stock markets are driven up over the long term by a few, if you like, hero stocks. Now, this is important for 2 reasons. One, I think it's an interesting context to look more generally about, how difficult is it to be a stock picker. In this sample, more than 2/3 of the stocks were below the average return, right? because the average has pulled up by a few superheroes. The bulk of the distribution, you can see it here, the median is way below the average. But if you think about the perspective of portfolio construction, if you knew that in the future, two things: one, in the future the distribution is going to look like this, and two, I don't have any real insight, any real crystal ball around to who is going to be the heroes. One way to think about portfolio construction is, I just want to make sure that I have participation in the future heroes. I want to make sure I don't miss out. And if I had no more information than that, I might think about equal weighting, because equally weighting maximizes your expected participation in those few superheroes. You're just making sure you don't know which ones they are, so you don't want to overweight, but the main thing is not missing out. So that's the theory behind it intellectually. When we actually look at the data, and I said that there are two slides in here that I think are quite specific to the particular market environment that we're looking at today. Here's the second one. So what we did was we looked historically, right? So you had the median performance, you had some 2, 5, 10x's, and we did an analysis to see how much of the performance of these quote unquote heroes was captured by the capitalization weighted index and by the equal weight index. And these are the results. So wanted to show both, but they tell a similar story. What was the average weight in these heroes, and how much did they contribute to the index return? And for the stocks, 492 or so that were above median, equal weight got a had a higher average weight, got a higher contribution. For the 2x, 5x, 10x, 20x, and 40x, equal weight had a higher allocation, received a higher, harvested, if you like, a higher proportion of their returns. But if you go all the way up to the two stocks that did more than 100x in terms of total return over the period, it's not a secret that the two are Apple, Nvidia, and Nvidia, sorry. Over the past 20 and a bit years, they got big, relative, they became more than a 2% weight, more than a 100th weight, and then they went from there to a really extraordinary performance history. And so the qualification to this is that no, in the case of the two best performing stocks, the S&P 500 did actually capture more. So first of all, look, we'll stay honest. We'll show you what the data shows us. But there is an important qualification to this in the terms of, could this happen again? And of course, we don't know. It could happen again. But if you have a stock that is already 5-6% of the S&P 500, if it was to outperform every other stock in the S&P 500 by a similar degree as it did over the past 20 years, its weight would need to rise from 60% to something in the mid-90s. I'm not saying that couldn't happen, but it seems unlikely to me that two companies will be allowed to dominate the entire US economy. And I use the word be allowed because there are not just market frictions on this, right? There are also other frictions in terms of regulation, politics, etc. Again, not giving you any opinion on those for the avoidance of doubt, but this is something that you might think of in terms of, could they do it again? So wrapping it all up, and I would invite people, the paper's available for free, it's called Worth the Wait. You can go read it, and it goes through in some detail size, factor, sector, and single stock perspectives, all of which we think are important in understanding how it was that the equal weight index managed to outperform the S&P 500 over its life period of performance.
Yeah, no, it's a fantastic summary. As we said at the top, such a simple idea, but there's obviously so much interesting data and analytics behind what actually drives the outperformance. I'm going to jump back a few slides actually. So we had a question come through when you were talking about size, and someone's asked around obviously the S&P 500 market cap index. That's a large cap index with some, I guess, large weights in some mega cap companies now as we coin them. The actual S&P equal weight index, it still shouldn't be thought of as a small cap index, right? You're still holding the 500 largest companies listed on the market. So it still actually would classify as a large cap index, which is an important distinction to make, I think, because some of the smaller cap indices, some of the smaller side indices like the Russell 2000s, probably one of the better known household names in the US. Of course, there's also S&P small cap indices as well.
Thank you.
to have, yes, an important shout out. They tend to have more speculative companies on there. It tends to be more volatility in returns. So I guess it's just an important thing to say the equal weight is a great way to get access to a smaller size bias than the market cap weight. It's a great way to, de-risk your portfolio from being overweight in some of the mega caps, but you're not moving all the way to small caps. And I think
Tom, we sort of showed some statistics that really evidence this, right? So the equal weighted average size of company, i.e., how big are the companies in the equal weight index on average? $100 billion, right? These are still all S&P 500 member companies, and half of them are in the top half of the S&P 500, to state the obvious, right? Small caps, and you mentioned, the 2000. There is a representation there from kind of penny stocks, from much smaller companies with market capitalizations in the the hundreds of millions or low billions. There is also I call it a quality filter, if you allow me to use that term. Strictly, there's a part of the S&P 500 methodology that in order to become an S&P 500 company, you have to at some point in your life have demonstrated a 12-month trailing profit, because at the point that it gets included anywhere in the complex in our mid, small or large cap indices, you have to show a 12-month trailing, among other conditions. So these are companies with an average size of $100 billion, with the associated liquidity that you might hope to find, and there is a degree of quality filter in terms of limiting any impacts from large but unprofitable companies.
Yeah, no, exactly right. It's an important distinction. So we have one more section here, which is from another great paper that you and the team put out last year, I believe it was last year, and we actually ran a webinar around this. But Tim, could you maybe briefly cover off on this active comparisons section?
Yeah, absolutely. Look, first of all, why bother, right? Many of the things that we've been talking about in terms of limiting or mitigating what might be perceived as too much exposure to the very largest companies, the discipline of regular rebalancing, capturing potentially a greater participation from quote unquote hero stocks. These are all reasons that some investors, market participants, turn to traditional active managers. And if you go all the way back to the beginning, I mean, talking about the average dollar versus the average stock, and what's a good benchmark for a stock picker? Well, what's the performance of the average stock, right? Well, what would you achieve by just picking a stock from the 500 at random? The expected return is what's the average return of all the stocks, which is represented by the equal weight index. So there's really good reasons to look at. First of all, are there connections between equal weight relative performance and the relative performance in aggregate of the, if you like, the stock picking community, which we study in our SPIVA scorecards. I'll show you some data based on US actively managed funds. I'll do it short and quick because there was a paper that we published last year, more equal than others, we called it, which looked at the relationships between equal weight and active returns. But look, top picture summary. First off, there is a connection. If you wanted to know ahead of our SPIVA numbers, how did active managers do? One of the things that I'll look at is how did equal weight do in relative terms. In years when equal weight does relatively well, that tends to be good for the stock pickers, and vice versa. When equal weight does relatively poorly, stock pickers tend to do a bit worse. That also, given that equal weight is a bit of a rough couple of years leading up into this one, that gives you a bit of perspective on why it's been so hard for active managers to match the S&P 500's returns. So this is just showing you a time series of excess returns year by year, average active manager and the equal weight index. And we also put together a year by year how many stock pickers managed to match or beat the equal weight index's returns. There's a lot of information on this slide, but look, here's the headline. The two are connected, but if you were thinking about is an equal weight strategy really inferior to stock pickers because they share the same characteristics, the evidence suggests that most active funds underperform in most years versus the equal weight index.
Yeah, no, great summary. Well, when we send around the recording and slides after the presentation. We'll be sure to link to all these papers we're referencing that Tim and the team have put together. So any section in particular you're interested in diving in further, you'll have access to do so. So with that, it brings us to how Australians can actually get access to the S&P 500 equal weight index. And BetaShares is pretty proud to offer both a QUS, which is our fund that most of you are hopefully already familiar with, our S&P 500 equal weight ETF, non-currency hedged. And more recently, due to a lot of investor and advisor demand, we have brought out a currency hedged version. I've had a few questions actually come through about the implications of currency hedging, so we will get to that. Just one note on this slide here, something that Tim did allude to earlier in the presentation. I mean, there's no guarantee that the equal weight index will have a more diversified sector exposure. It's just going to come down to how many companies actually sit within each sector, given the equal weighting methodology. Throughout history, we have tended to see not only greater stock diversification, but also greater sector diversification. And obviously, the biggest tell of that at the moment, as you can see here on the right-hand side, you've got the pie chart of the S&P 500 market cap weight, and the big orange slice of pie there is, of course, the information technology sector, which has such a large weight, but a much lower weight in the equal weight. So again, a great tool. Both these funds are great tools to help to, I guess, reduce that concentration we're seeing in indices, not just the S&P 500, but global indices are impacted just given the size and scale of these US companies, as well as a great sector diversification tool as well. Just, I guess, one comment on the current context that me and Tim touched on at the top, and then I'll get into a few implementation ideas for Australian investors. I've really enjoyed this slide here. So we've been talking a lot about earnings the past few years, and one of the stats you might have heard thrown around is since 2022, almost 100% of the earnings in the S&P 500 or the US markets has been driven by that small cohort of companies, that small cohort of large cap technology companies, and that goes a long way to explaining why they've had such strong outperformance. It's been backed up by strong earnings. What's really interesting though, looking ahead, so not only do we have those record levels of concentration, do we have momentum starting to subside a bit, we're also seeing, and something that may back up equal weight performance, is a change in the earnings landscape. So what I have here is the consensus earnings for 2025 and 2026 from the NASDAQ 100, which is even more concentrated in those large cap tech names, the S&P 500 market cap, and of course the equal weight in orange. And what you can see is this real convergence. Well, as the large cap technology names, as their earnings growth normalizes, they've been at fairly extraordinary levels for the past year. As those normalize, we're also seeing the equal weight, or the rest of the companies in the S&P have an acceleration expected in their earnings, likely because we're seeing like the interest rates coming down, there'll be less pressure on those companies in terms of interest, but also that's better for the consumer, and should or could hopefully support a broadening out of the market and support a lot of the things we've talked about today in terms of that reversal of the equal weight versus the market cap weights performance. And then I did just want to touch on quickly, the decision really isn't do I just put my whole portfolio in the equal weight index, so I put it all in the S&P 500, or for instance the NASDAQ 100 like we have. The NASDAQ's one of our most popular funds here at BetaShares. And so we ran some analysis just looking at when does the NASDAQ tend to outperform the S&P 500, when does the S&P 500 equal weight tend to outperform the S&P 500 market cap weight. And maybe more unsurprisingly, given some of the momentum factors we've spoken about today, NASDAQ tends to be quite a momentum-driven index, being those large technology names. So we tend to find their outperformance and underperformance is negatively or shares a negative relationship. And what that means is by combining those two exposures, or a portion of those two exposures, you can really look to adjust your risk and return profile of your portfolio. If you do a simple 50-50 blend, as I've got in the table on the top right side there, over this historical period, this 20 years, you would have actually, this past 30 years, you would have improved your risk-adjusted returns just because of that negative correlation really of the outperformance. So that's one way investors can think about investing in the equal weight index, not completely replacing their portfolio, but maybe blending it in to achieve greater diversification along the way. And then just finally, a comment on currency hedging. We've had quite a few questions actually come through about the currency implications. And I think a lot of the interest we had in a currency hedge version of the equal weight is because a lot of the thinking around I guess, reversal of the fortunes in those mega cap technology names might go hand in hand with an appreciating Australian dollar. The reason being is, I guess, a lot of the market theory at the moment is we're going to see a reduction in interest rates. We're going to see the US lead that off probably next week. And the US has further to go to drop interest rates. They obviously raise interest rates higher. So we're going to see interest rates drop, US interest rates drop, more than Australian rates, which could be supportive for the Australian dollar. Not only that, once interest rates do drop, if we do see a soft landing, markets might start to look forward to what comes next, which could be a cyclical acceleration in a lower rate environment. So that is also bullish for the Australian dollar. If we think back to the 2008 period, and what I have on screen here in orange is just the Australian dollar versus US dollar exchange rate. So as that orange line goes up, the Australian dollar is appreciating. And the grey line is actually a line we had in an earlier slide. It's just the cumulative relative performance of the equal weight versus the market cap weight. So as that grey line moves up, the equal weight is outperforming the market cap weight. And you can see in that 2008 to 2012 period, we saw a cyclical recovery in the economy, saw a resources boom, and we saw the Australian dollar provide strong, the Australian dollar appreciated, sorry. At the same time, we saw a greater performance of the equal weight versus the market cap weight. As we saw a cyclical acceleration, we saw a broadening out of equity market returns. So if that is your thinking towards the next part of the market cycle, it's great that we have the currency hedge version available now, so you can make that pick yourself. You can use the unhedged version or the hedged version, or even a blend of the two to your liking. Those are my slides, Tim. I don't know if you had any comments on any of those, and if not, we can open up to some questions.
Look, I think there's the thing that I think is super interesting there is the degree of earnings growth that we've seen in those mega caps has one, helped support their performance, but two, has, if I might share an opinion, and there's data behind it, but has introduced a level of fragility at the very top of the market that's been evidenced in the past couple of weeks by the market's overall reactions to earnings. Even those mega caps that were meeting earnings expectations or even slightly beating, if they didn't say the right things in their earnings call, that was having an effect on the entire market. Mm-hmm. That sort of introduction of what I would think of as purely single company idiosyncratic risk mm-hmm. as a driver in overall markets is a signal to pay attention to how you're managing risk, I think. And the sort of notion that there is a rest of the market that you could take more exposure to, or have less sensitivity to the very biggest names, I think is another way of emphasizing the choices that are available now and how they're slightly more important than they usually are.
Yeah, no, it's so true. And again, I'd reiterate, it's not even like we're saying, in the recent earnings calls, referencing Nvidia, for instance, they beat expectations, but they didn't do it by enough apparently, and they traded down the day. That didn't only impact the S&P 500, that impacted the MSCI World Index, which is just incredible. We've gone beyond just the US indices, to Tim's point. And I think it's a really good point when a lot of clients ask me, looking ahead, where do you see risks in portfolios? Like we do a lot of portfolio analytics, and two of the key risks I come across at the moment, number one is concentration risk. It's not only, say you're a manager using a blend of passive indices and active managers, if you look under the hood of a lot of those global indices, a lot of the global active managers, it is not unlikely that a lot of those managers are not only concentrated, but concentrated in the same names. So using the equal weight just to de-risk portfolios, using the equal weight to get exposure to the rest of the market, and yeah, exactly that, and not be as exposed when there are these sensitivities at the top of the market, as Tim alluded to. And the second one is, I think, around again from an Australian perspective, around currency risk potentially, and that's why it's good to have that that hedged version. The Australian dollar tends to be fairly directional, and we've had a very long period of the Australian dollar depreciating against the US dollar, which has been ultimately good for unhedged investors. But it can trend just as strongly in the opposite direction. That does have a material impact on portfolios. With that, we'll just reiterate that obviously, all investments have risk, and even the equal weight has certain risks to it. So please, read the PDS and TMD and fund page to learn if it is appropriate for yourself. And obviously, no future guarantees of outcomes. As we mentioned, Tim and the team put out just really great reports, and it's an absolute pleasure to be able to get Tim himself on to talk through the reports they put out. But we will send around, after the webinar recording, as well as links to all the great work the S&P do on the equal weight and all their other indices. And just finally, of course, you can subscribe to our own channels for insights, webinars like this one as well. But with that, Tim, we have one or two questions come through, so I might just pick two of them. We've kind of been covering them throughout the webinar, which has been handy. One that's come through a few times is just around your opinion on the election, on the US election. I don't think you can run any webinar with anyone at the moment without that question popping up. So it'd be good to get just your thoughts on how the election could impact markets in broader, or if you're able to decipher an impact on the equal weight versus the market cap weight.
Yeah, sure. So look, my prediction on the US election and the way to best manage it, and I'm just kidding. Obviously, we don't have a house view, and as an index provider, our goal is just to measure the impact and report the impact on the markets. I will say the following though: elections historically have tended to not, and in the US in particular, have tended not to be, an overall good thing or an overall bad thing for the overall market. What they've tended to do is to create dispersion. They've tended to create winners and losers, and this is often viewed helpfully from two perspectives. One, which industries are going to benefit or suffer from either be it investment, regulation, or sort of combinations of the two. And so the first one, think about the different sectors, think about the different industries. The other is large versus small. Companies that have large global distribution chains, global supply chains, global revenue sources versus smaller, more domestically focused names. So I think those two perspectives are quite interesting to look at in terms of understanding where such differences may emerge. And that does, in a sense, come back to what we were talking about earlier around managing idiosyncratic risk. And a broader point that I might make here. Famously, diversification is sometimes said to be, quote unquote, the only free lunch available in finance, because you can, by diversifying, you can reduce risk in theory without changing the return. Ultimately, right, you just get the average returns, but your risk diversifies. And if you're thinking about managing risk through a period when you're expecting a moderately higher amount of dispersion of winners and losers, diversification is a way that historically would have helped to manage those risks. Diversification can be done through a really technical perspective, looking at correlations, structural breakdowns, blah 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 blah. Or you could just think about simple structural ways to diversify, which again come back to the definition. Equal weight is it's naive, but historically can be quite an effective way to diversify. Just manage how much risk you have in each individual position. Yeah,
exactly. And it kind of all comes back to that, right? Like what we're talking about is there's heightened risk at the moment, and here is a way to potentially de-risk that in a very simple way to sum that up. We'll just go to one more cognizant of time. Another one was around valuations. We didn't touch on valuations at all during our presentation. We didn't touch on it historically. It might be intuitive to some, but I don't think so. Also, maybe a comment, Tim, on valuations of the equal weight versus the cap weight currently and historically.
Yep, sure. I mean, look, you will not be surprised to discover that if you look at the valuations at the very top end of the market. There is a distinction between the relative valuations of the largest names versus the rest of the names. That's historically not unprecedented, but unusual. And you see that it sort of doesn't really matter. You look price to book, price to sales, price to earnings, and so on. So there is more of a valuation gap between the two indices than is normal. If you look at the past sort of year and a half, that valuation gap has been looking more stretched than normal. Historically, over the super long term, yes, there is sort of market timing information there, but it comes with the same qualification that all value-based strategies do, which is that valuations are not a great way to do short-term market timing, and they can certainly get worse before they get any better. I guess I'm sort of qualifying, and that's why I didn't really focus on it. I also think that the aspects of size, sector, individual stocks are probably more important, but we did touch on it very briefly. There is a valuation aspect there. There is a relative valuation sort of way that one might think about equal weight. But I think if you are a born and bred diehard value investor, there are other ways to do that are probably more consistent with the purity of the value style.
Yeah, no, very well said. And just one I can cover off, because Sebastian has asked, I think, earlier in the webinar around momentum and how can one identify the gains and losses of momentum. Well, Tim mentioned earlier, we use the data. Actually, S&P have a momentum index, so that's one very easy way to track how momentum is going. And we also actually just launched, the Beta Shares just launched an Australian momentum fund as well. To the S&P's got it on the US market there. We've got a fund that is using a momentum-based strategy in Australia. So there's a few ways you can get an idea of how momentum is performing outside of just looking at the equal weight versus the cap weight potentially. But with that, I think that will bring us to the end of today's webinar. So again, Tim, as always, a pleasure to have you on, and really appreciate your time and your insights.
Yeah, it's been great. Thanks, Tom.
Appreciate it.